Shishir says how to deal with a runaway married put where the price is well above the sold call and put price, i.e. AMD. I liquidated for a loss even though the price was well above the sold call. I meant to go to the portfolio. You probably shouldn't have liquidated, Shishir. Following the rules in the blueprint, there's a few ways you can manage income method number one, just using income method number two. Income method number one, of course, just selling a call against the married put structure. And income method number two, I'm sorry, that's income method number two. You maybe could have been able to convert it to an income method number six the first minute it jumped. The first day it went above the short call strike price, and the gain in the long call would have balanced it out, and you still would have had unlimited upside profit potential. Yes, it's related to timing, but that's why you have the blueprint there to teach you these methods. Prior to, let me go back to this, blueprint infusion. I know the stock price number I had. I forget my original price of the put. It was 23.05. Okay. So let me put that in. I'm going to go my portfolio. We're here. I'm going to enter the married put that was my original married put position on AMD. Is it AMD? 100 shares bought a month and a half ago, sometime in here, at 96.45. And it was the January 110 at the time. It was 23.05. Is that what we said? 23.05. Perfect. Now, it doesn't have to be the exact date, but 321. Okay. So as I mentioned, there's my married put position. It's been in it about 66 days. What has happened in those 66 days? Not that. Sorry about that, folks. Again, so I got in somewhere in this time frame around 96.45. Stock went up. I could have done an IM number one here, pulled back. I could have done an IM number 9 here. I didn't, following the rules in the blueprint. I could have actually done a 3 and 9 combination here and taken the risk down from that 8.8%, 8.9% originally down to 2%, and probably been at break even and profit right here. Okay, but where am I going with this? I paid 96.45 and I have the 110 put. Stock started to recover here, move back up after this being in this valley. We're at the 11th. Okay, so May 11th. I'm happy now, Shishir. I'm in this position. It was well below my put strike price at 110 at the time, starting to move back up. I need to get some premium. I need to start hedging this. So on May 11th, let me erase the drawings, I went ahead and sold the 110 call. Why the 110 call? Because I have the 110 put. Never going to sell a call below my put strike price. I know you had a different structure perhaps, but let's go back to May 11th again on the chain. Sorry, let me just go to the chain for AMD. And May 11th, I'm sorry. Okay, we're at that point now, I'm sorry, where the database is uploading all of today's historical data, so it's going to take us a little bit of time. You said 4 week out, so I'll just call it the June 9th series. I sold the 110 call, not a lot of premium, only about $1. Wow, that's not great. But okay. At the time, I was deep in the money with the put for the proper risk, 91 cents. Let's call it $1. Okay? So on May 11th, we're going to sell. Oh, what was that? June 9th. Sorry, folks. What was my expiration here? Yeah, June 9th. So let's add an option leg. It's only 14 days left now. Remember, we did this on May 11th when it was 4 weeks out. And the 110 call, my apologies, folks, is $17 now. This is on the 11th of May. Stock price was like 97 something. And we got $1. Let's keep it simple. So here we are now. I sold it for $1. Let me see if I even would have done this first. Yeah, maybe I could see myself doing that at the time in a panic, but I didn't panic, and I held on to the open married put, and that's why I was able to adjust the put now to lower the risk. In any case, here we are. Stock's at 127. Basic intrinsic value plus 60 cents a time premium for the remaining 14 days to buy to close this call. Liquidation value, I'm at a profit of 0.8%. What can power options do for me? What can radioactive trading do for me? Go to position actions, go to position analysis. Just like you could roll, potentially a covered call that is going against you. We see opportunities here to buying back the short and rolling to a higher strike further out in time. Am I going to be able to roll for a credit? No, not necessarily. But right now I'm looking at a gain of 0.8% with a gain of 0.9%. If I hold this to July, the remaining time value comes out of it. I'm sorry, June 9th. And the remaining time value comes out at 1% left. It's that deep in the money. But I can increase the percentage return even if I roll for a debit by, say, going up to 1 week out in time, the 16th of June 135 call. Yeah, I'm paying $17 to buy it back, and I'm getting another $360, so I'm down $13.60. But the stock from when I sold the call, when it was at 97, has moved up 30 points. Okay, so I'm taking a debit. I'm going to increase my risk on this position. It's not shown here, but I'm going to increase the percentage at risk because of that debit. But at the same time, I can bump up the return. The risk goes up to 17%. Maybe I wouldn't do this one. It's a little bit too close this year. But that's a better looking chart in my opinion, especially if I think the stock's going to continue to move up. Now, this is moving the call first. You always move the call first. That's what's capping any further gains in your position. It's not the put. When you have a runaway like this and you've sold a call against the married put, what's hurting you the most is the call. That call delta is going to 1. Your put delta is down to 0.3 or 0.4. You're not gaining any more on the stock because that call delta is at 1. You're losing dollar for dollar every dollar the stock goes up while still losing 40, 30, 50 cents on, or 40 or 30 cents on the put that's getting further out of the money. But once I perform this roll to lower this risk down, which would also increase my cost basis, I can manipulate the put. I can manipulate the put in that case too. That's why the blueprint's important, because it shows you the opportunities of if, when, and why, what happens. I have an income method number 1, the stock runs up, what can I do? Let's look at the chart again real quick. Okay, so I had mentioned that on the 11th, when the stock was here, finally got back to a good range, we went ahead and sold the 110 call. Right here, when the stock's reaching the short call strike price, I might have been tempted to move it up, the 115, 120, or might have considered buying a 115 or a 120 in this case to convert what would have looked like that income method number 1 position into the married put with income method number 6, which leaves the upside open, still gets a premium to reduce the cost basis, but this would have been done at a debit. This would have been an IM6 at a debit, which we don't prefer to do, but it's an action you can take, discussed in the blueprint. Different ways to manage the position. The importance, A, of having the blueprint to have those abilities to, the education, I should say, and the description of how to manage X, Y, or Z if the stock moves against you rather than just liquidate it and taking it to a loss. Again, other point that I mentioned for Faoud. If this was the actual position I took when the stock moved back up to 97 and I panic sold this 110 call for only $1 to lower that risk down, and I would have run my what if scenarios. Am I comfortable if the stock stays right at 97? Yeah, I've hedged the loss a little bit. Am I comfortable if the stock moves up 5 or 10% to 110? Yeah, I'd love that. Am I comfortable if it moves up to 20%? Not sure. 25%? Not quite. Do I expect the stock to move up 25%? No. What I never like to see with selling a call against the married put is this structure. I never like to see the double break evens. I don't sell a call if that's what I'm seeing. If I got $6 for this premium, which I wouldn't have, that's a little bit better. But what I typically look for in this case is now that the stock has moved up, and I didn't do this first. I rolled the put first. But if I sold the 130 at 355, That's the graph I want to see for an income method number 1 on a married put position. I don't want to see a double break even. I don't want to see an upper and lower break even. Remember, I entered this position because I was neutral to bullish on the stock. I was bullish on the stock, 3 to 5% the first 20 to 40 days, with a potential for another 5% or so in the next 60 to 90 days following that. Why would I ever put myself in a structure to force myself to sell a call against the properly structured low-risk married put where I have an upper and lower break even on a stock I'm bullish on? Follow the sentiment of the trade. Follow the sentiment of the structure. And again, that just illustrates the importance, of course. Number 1, the education of having the blueprint, the electronic version you can access at any time, to know the ins and outs of each income method, how to properly use it, how not to use the income methods to get you into trouble, how to manage an income method once you're in the position. There's 12 different income methods. Why? Because there's different market conditions. It's a bullish structure. The stock moves up. I want to use income methods such as 1, 3, 4, 6, 5, possibly 11. Stock stagnates. I might like to use 6, a version of 7, income method number 8. The stock falls. I want to use 9, potentially income method number 12, potentially a 6 and 9 combination, potentially a 3 and 9 combination. I know I'm not telling you what these are. I'm not giving everything away for free. But that's what's discussed. That's why the blueprint is important. We don't share everything in these webinars. Everything is in the blueprint. But in addition to that, the advantage of also having the PowerOptions tools to track your positions. And as you enter those different adjustments, evaluate using the position actions and position analysis. Same thing we tried to do earlier for that bear call spread. You could do a covered call, naked put, calendar spread, debit or credit spread, iron condor. Go to position analysis, see where you stand, and then you'll see potential rollout opportunities where we do the math for you. One rule that I already mentioned for free, you're in, sorry, let me go back, folks. You're in this type of structure here, whether it's the proper setup or whether you entered it this way. The last thing you want to do is adjust the put first. What's hurting your position is the sold call that's going closer and closer to a delta of 1, mitigating any positive delta you had on the trade. It's not the put that's hurting you the most right now. It's the call that's negating any upward further stock movement. Evaluate, approach, and adjust the sold call that's deep in the money now first. Then come back and look at the cool ways, 4, 3, 9, 12, that you can adjust the put option, manipulate the put option to take the risk back down to a manageable level, still give you good protection in place, and still give you potential for good, strong profits in those scenarios. So there are ways to do it. There are ways to manage when you've sold a call against the position and the stock suddenly swings up on you. We've got the tools to help you evaluate that. And as I mentioned, we've got the full education to help you take care of that in the blueprint course there, which you can see at PowerOptions in the products page, or of course at radioactivetrading.com.